Well, there's been a lot of talk lately about the Strait of Hormuz being shut down again and what that could mean for oil, gold, and silver. So, in this video, we're going to separate what is actually happening from what people are emotionally projecting onto the market. And you are going to walk away feeling a whole lot calmer and a whole lot sharper about what may happen next. It is Sunday, April 19th in New York, and comment below with the day and date you're watching from. And real quick, if you value the way I break this stuff down, support the channel by subscribing and by commenting John AG Best so I know you're here and you want more of this kind of analysis. Now on the surface, this story sounds simple. Iran tightened control over the strait again on Saturday after briefly reopening it on Friday. Merchant ships were warned off. At least 2 vessels reported gunfire. And negotiators on both sides were still saying there had been some progress, even while major gaps remained. That is exactly the kind of setup that gets people leaning way too hard in one direction before the futures market even opens. Because when traders hear shipping lane, gunfire, and Hormuz in the same breath, the first instinct is to jump straight to a giant conclusion. Either oil has to go vertical and metals have to crater, or gold and silver have to rip instantly because the world looks scarier. But markets are usually a lot messier than people want them to be. So let's slow this thing down. What is actually confirmed is serious enough on its own. Reuters reported that merchant vessels trying to cross on Saturday received radio messages from Iran's navy saying they were not allowed to pass, and shipping sources said at least 2 ships were hit by gunfire and turned back. At the same time, talks were still alive in the background, with both Washington and Tehran pointing to some progress, even while the Strait of Hormuz remained one of the unresolved issues. That matters because the market does not only price the event, it prices the durability of the event. It prices whether this is a brief show of force, a chaotic bargaining move, or the start of another stretch where maritime traffic stays restricted long enough to keep energy traders on edge. And those are 3 very different market stories. According to the latest publicly available energy data, this waterway is still one of the single most important oil choke points in the world. In the most recent full-year data, around 1/5 of global petroleum liquids consumption moved through it. More than 1/4 of total seaborne oil trade passed through it, and roughly 1/5 of global liquefied natural gas trade did too. There are bypass routes, yes, but they only cover a slice of the volume that normally moves through there. So if traders believe traffic stays constrained, they do not need a perfect worst-case scenario to bid energy higher. They just need enough conviction that flows remain messy, shipping costs rise, insurance costs stay elevated, and buyers start scrambling for alternate barrels. That is why oil reacts so fast whenever Hormuz starts sounding like more than just a headline. And we have already seen how sensitive the oil market has been. On Thursday, crude jumped sharply again as traders doubted peace talks would quickly fix the disruption, and Reuters reported Brent settled near $100 while U.S. crude closed in the mid-90s. Just one day later, oil fell about 1/10 when the market briefly believed passage was reopening, only for fresh uncertainty to hit again after Tehran reimposed tighter control. That kind of whiplash tells you this market is trading expectations, not certainty. Now let's connect that to gold and silver because this is where people tend to oversimplify the most. There has been a recent pattern where sharp energy stress has not immediately helped precious metals the way casual observers expect. In fact, Reuters noted this week that gold had slipped after the initial late February strikes on Iran because surging energy prices fueled inflation fears and pushed markets to scale back expectations for interest rate cuts. Then, when oil dropped on hopes of reopening the strait, gold extended gains and silver pushed above the low 80s. So yes, there is a real short-term logic for why an oil spike can pressure metals first. If crude jumps, traders start worrying about hotter inflation, firmer yields, delayed rate cuts, and tighter financial conditions. Gold does not pay yield, silver is even more volatile, and in that kind of environment, the first move can absolutely be lower. But here's the part where I want to challenge the lazy takeaway. That relationship is a behavior pattern, not a law of physics. If this turns into a broader confidence problem instead of only an oil problem, then gold especially can stop acting like a rate story and start acting like insurance again. Silver can lag at first, then move like it got launched out of a slingshot once buyers decide the washout is over. So anyone telling you there is only one possible market reaction here is selling you false certainty. And that is dangerous, because gold is not sitting at sleepy old levels anymore. Reuters reported on Friday that spot gold was around the upper 4,800 range. U.S. futures settled near that same neighborhood, and spot silver was a little above 81. Those are not casual levels. Those are elevated levels that have already been built on safe haven buying, a softer dollar, strong investment interest, and a market that has been repricing geopolitical risk for months. From the broader gold side, the foundation under the market is still not weak. The World Gold Council said total gold demand in 2025, including over-the-counter demand, moved above 5,000 tons for the first time. ETF holdings rose strongly, bar and coin demand hit a multi-year high, and central banks still bought more than 800 tons, even with prices already at records. In plain English, the market went into this Hormuz weekend already standing on a strong base. Silver has its own underlying support too. Reuters reported this past week that the global silver market is expected to post a sixth straight annual deficit this year, with the shortfall widening versus last year. The same report warned that another squeeze-like setup could emerge if volatility rises, Indian demand reactivates, and investment products pull metal into storage. That does not stop silver from dropping hard in a panic. It just means the bigger structure underneath it is not exactly loose. So when I look at this setup, I do not see a neat one-line answer. I see layers. Layer 1 is the immediate energy shock. If the strait remains tightly restricted into the open, oil likely carries a fresh risk premium. Layer 2 is the inflation and rates reaction, which can hit metals first. Layer 3 is whether the market starts treating this as something deeper and more systemic, in which case gold may hold up much better than the first wave of selling suggests. And Layer 4 is silver, which has a habit of behaving like two different assets in the same week. That is why I am far more interested in the quality of any drop than the mere existence of a drop. Does gold get hit and then immediately find buyers? Does silver flush lower and snap back? Does oil gap higher and hold, or gap higher and then fade? Because traders think diplomats are still inching toward some kind of temporary understanding? Those questions matter more than one loud prediction. Now, there is another fresh detail here that people should not ignore. Reuters reported that hundreds of vessels and about 20,000 seafarers were still stranded in the Gulf even after Friday's brief reopening. So even when the rhetoric softens, the physical system does not magically return to normal in one clean motion. Traffic backlogs, hesitation, insurance concerns, security checks, and military uncertainty all keep the market nervous long after a headline says things are open. That means a partial reopening is not the same thing as normality. And it also means a renewed shutdown or renewed restriction lands on a market that is already fatigued, already suspicious, and already sensitive to every new radio message and every fresh shipping incident. There is also a broader macro piece that is not getting enough attention. Reuters reported that the International Monetary Fund this week raised its base case forecast for this year's oil prices by about a third versus its January outlook, while also trimming its global growth view. So the world was already being told to expect higher energy costs and weaker growth before this latest weekend twist tightened the screws again. That is not exactly a friendly mix. Higher energy costs can weigh on growth, complicate central bank decisions, and keep inflation worries alive at the same time. And that is one reason I do not think you can reduce this whole situation to oil up, metals down, and call it a day. That may be the first move. It may even be the dominant move for a while, but it is not the only force in the room. I also think people forget how uneven this shock is geographically. The latest official U.S. energy data show Asian buyers are far more exposed to Hormuz disruption than the United States, and U.S. imports flowing through the strait had already dropped to a very low share of American consumption. That does not mean the U.S. is immune. Global oil is global oil, but it does mean the pain is not distributed evenly, and that affects how governments, refiners, and traders respond. Here's another reason I do not want people getting hypnotized by one dramatic narrative. The futures market and the physical market have not been moving in perfect lockstep. Reuters reported that in parts of Europe and Asia, prompt physical crude prices surged to extraordinary premiums while futures were much more restrained, which means the paper market has been trading hope, while parts of the real market have been trading actual scarcity. When those two worlds drift too far apart, volatility has a nasty way of coming back. That split matters for metals too, because if traders start losing confidence in the paper signals coming out of the energy market, they can rotate back toward hard assets. Sometimes gold moves because rates matter. Sometimes gold moves because trust matters more. And the workaround story has limits. Official U.S. energy data shows Saudi Arabia and the UAE do have some pipeline capacity that can bypass Hormuz, but only a few million barrels per day of spare rerouting capacity is estimated to be available. That can soften the blow, but it does not replace the full river of energy that normally moves through that corridor. So yes, the system can adapt over time. No, it cannot pretend this choke point does not matter. There is also the shipping psychology side. Once crews have heard gunfire reports, once insurers start repricing risk, once owners start asking whether a voyage is really worth it, the system gets sticky. Even if the official line improves, private decision-making does not reset instantly. That friction alone can keep energy nerves elevated longer than the headline cycle suggests. And then you have the currency piece. Reuters reported on Friday that a weaker dollar helped gold when reopening hopes pushed oil lower and eased inflation concerns. That is another reminder that metals are never reacting to just one thing at a time. Oil, the dollar, yields, war risk, growth fears, and safe haven demand can all be pulling at once. That is why silver can look confused in the short run. It is trying to respond to macro fear, industrial expectations, and precious metals sentiment all at once. So if somebody tells you tonight's open is easy to call, step back from that confidence. This is one of those moments where humility is not weakness. Humility is edge. Let the opening reaction happen. Then ask whether the move makes sense, whether it is being confirmed, and whether the second hour tells a different story than the first 15 minutes. That is where patience starts paying dividends. We are also seeing the region stay unstable outside the strait itself. Reuters reported Saturday that a French peacekeeper was killed in southern Lebanon, 3 others were wounded, and an Israeli soldier later died of wounds from a separate incident, all against the backdrop of a very fragile ceasefire. When multiple flashpoints stay active at once, markets stop treating the problem as a single-lane shipping dispute and start pricing wider disorder. And when wider disorder gets priced, gold does not always stay weak for long. So what am I expecting tonight? If conditions look roughly the way they do now, I think the first move could absolutely be rough for metals, especially silver. Not because the long-term thesis is broken, but because energy stress can force a nasty short-term repricing. At the same time, if gold and silver refuse to break meaningfully, despite a still ugly Hormuz backdrop, that would actually be one of the more bullish outcomes possible. It would tell you this market is already looking through the immediate oil shock and back toward the deeper monetary and geopolitical story. That would be a huge tell. So, stay out of FOMO. Stay out of panic. Stay out of that emotional place where you need to predict every candle before it prints. If you're successful, share your success story in the comments so others can stay motivated. For me, I still lean toward holding and selectively buying weakness rather than trying to outsmart every geopolitical headline. I am not saying everybody should do that. I am saying that is where my bias sits. If metals get slammed first and nothing in the bigger thesis really changes, that may be opportunity. If they hold firm instead, that may be even more important because it would show underlying demand is absorbing stress at already high levels. Either way, watch the reaction to the reaction. Watch oil, watch yields, watch the dollar. Watch whether the first red move in metals attracts buyers or whether sellers keep control for longer than they should. That second step often tells the truth. And let me ask you this. If gold and silver open lower, do you see danger or setup? And if they barely flinch while Hormuz still looks messy, do you think the bigger breakout is already underway? Let me know below. This is for educational purposes and market discussion only. I am sharing how I am reading a live setup, not handing you a buy or sell order. So think clearly, manage your own risk, and never outsource your judgment just because somebody on the internet sounds confident.